Common mistakes by property investors, they overborrow. If you build your portfolio up, you're getting like 5 or 6 properties in there, you might not have a tax problem anymore. I need asset protection. And then you can move to a trust. You need a depreciation schedule so you can claim depreciation back on the property. And you can take that schedule to your accountant and you get this thing called a variation certificate, and they'll vary your PAYG tax. They'll take less tax out of your weekly paycheck. One of the negatives about owning real estate as an investment is welcome to the Passive Property Investor Podcast, where I teach you how to stop trading your time for money with property investment. I'm Jerry Parker, your property investment consultant. Let's dive in. Hey, it's Jerry Parker back here again with the Passive Property Investor Podcast. Hey, let's get back into it. Let's talk about this. How should you manage your money as a passive property investor? Like, how should you do that? Look, as from the property investor point of view, I've always said that the finance and the money management is 50% of the deal. So let me just set up this scenario. Say you've got your home loan and now you've put some equity out. Now you've bought an investment property and you did the right thing. You kept 2 separate banks. And the passive property investment way of managing your money is you have an offset account against your home loan, and there's the rental income that comes from your investment property that goes in that offset account. And then you're out there working and your wages, that goes into that offset account. And you attach a credit card, not a debit card, but a credit card to your offset account. And then everything that you buy and you pay for, you use a credit card. And you can do this because you manage your money properly. You're not going to go buy stupid stuff, and you're never going to break the religious principle of paying credit card interest. Never pay credit card interest. And you're going to manage it this way. The credit card's going to give you 60 days extra before you have to pay for that thing that you just bought. And that's 60 days of that money being offset against your non-tax deductible home loan, because this is how we reduce our tax, and it literally reduces the length of your home loan. You can cut your home loan length in half by managing your money this way. So that means your wages that goes in there reduces your home loan. The rental income from the investment property goes there and reduces the home loan. I mean, of course, you'll have to bring it back out to pay the other bank, but still, this is the way we're managing our money as a passive property investor. Now, what if we want to make other investments and we don't have enough to buy another property? Well, we can pull money from that account, or you can pull more equity out of your house for this purpose and then make another investment that way. Now, should we do that, or should we just invest in property? No, this is diversification. Just like in property investing, we might want to diversify between Sydney and Brisbane and Adelaide. So we're covering the whole market. We go into other investment categories as well. And that's in the share market in Australia and overseas. I really like US tech stocks right now. I think that's going to go ahead. And then, there's crypto and gold. Those are both inflation hedges. Crypto is kind of the newer one. It's very volatile. And gold is pretty steady, and it's been going up because of all this inflation we've been having. And so, yes, of course, you should diversify over those asset classes and also internationally. What about the entities that you use? You can buy property in your personal name. You can buy in a trust, which could be like a private trust, or even your superannuation trust or self-managed super fund, or just in a company. And all these, they're slightly different and they're all available for you. I always start people out investing, especially if they're paying a lot of tax. If you're making $120 to $350 a year, you're paying a lot of tax. And this is the big bear we want to get rid of. And so we do it in our personal name, because we want the tax advantages from the investment property. But then, lo and behold, if you build your portfolio up, you're getting like 5 or 6 properties in there, you might not have a tax problem anymore. You might be getting depreciation, going like, wow, I need more, I need asset protection. And then you can move to a trust format, and that'll protect you. A trust, think of a trust as this. It's just another person. You've just created a person out of thin air, and it holds in the assets, but also is responsible for the liabilities of the assets. So it's not you, it's the trust. And if the trust does something bad or loses money, well, they can't come after you. They come after the trust assets. Trusts are also flexible. They help you if you got kids. This is the structure that I've set up is you have a company that's a trustee of the trust, and then your kids are beneficiaries of the trust. And, if your 15-year-old kid, he doesn't pay any taxes, but you can send him some money, and then he's on his very low tax bracket, and he pays a lower tax bracket than you, then you're saving tax. And then he can give you that money straight back again. And they do require you to have a reason for giving that money back. And the reason is this: you feed him, you pay for his school, you pay for everything, and he's just paying that back to you now. And so you can wash a bit of money through your family with trust. Sometimes companies are good to be the trustee of a trust, and they are good entities as well to keep you at arm's length for asset protection purposes. So if you're an investor and you want to manage your cash flow from your rental income, you want to put it up against that, against your home loan to keep that reduced until you no longer have your home loan. And then you have this pile of cash in this offset account, and that's offsetting your home loan. And often if you pay off your home loan, then you're going to pay tax on that. And this has become, or you can keep the cash there. I'll say this about property. One of the negatives about owning real estate as an investment is that it's not as liquid as, say, gold or the share market. And having that cash there provides you that balance of liquidity. So, if like a big problem comes, like interest rates triple, and you go like, oh my gosh, I need money, everything's so bad, I don't really want to, I have to sell my property. Well, no one wants to buy your property now, and you're kind of stuck a little bit. But if you have cash there, that gives you that balance of liquidity against your illiquid asset known as real estate. Common mistakes by property investors. It's the biggest mistake people make, in my view, is they over borrow. And when the volatility hits them of interest rates or vacancy periods, when the cash flows don't match, they're too close into the wind and they start going into negative. They have to pull money out of their savings to cover the interest payments. And then typically when interest rates goes up, property values go down, and in this pressure of having to pay more, it goes, oh, I feel like I have to sell it. Well, now you're selling it at the wrong time. And why is this happening to me? I thought real estate was such a good investment. That's because you over borrowed. You didn't take your risk parameters seriously enough at the beginning. Maybe you got sold into something, or you got seduced into paying too much, maybe fear of missing out. These things that creep in that take your rational investing away. Taxes for property investors, this is really important. And I see a lot of investors missing out on this. You need a depreciation schedule so you can claim depreciation back on the property you own. And you can take that schedule to your accountant, and you get this thing called a variation certificate, and they'll vary your PAYG tax. And you take that certificate, you give it to the person who's in charge of your PAYG tax, and now they'll take less tax out of your weekly paycheck or monthly paycheck. And so you're getting that cash flow back now. But a smart money manager takes that money and stores it in their offset account and gets ready to invest that again, because that's your taxes coming back from the depreciation on your property. So we talked a lot about what to do with your cash flows and your money, but here's your guiding principle. You need X amount of money to live. That means that there is a budget that you live in, and you come up with your living budget and you put everything in there you need. And then when you have the excess, you don't break that budget, and your excess money you invest, and you keep diversifying it and you invest. And property is such a great one because you get to leverage the bank's money and it's safe. It's safer than the Australian share market. You control how much you borrow and invest, but still diversify over the gold, shares, crypto, art. You keep investing, and that's what will set you free in the end. So I hope you found that valuable. This is a little bit about the way I run my life, and I try to. I'm a lazy person. I don't like working. I like just my assets going. I like counting money, and I like making investments. I like winning. Sometimes I lose, but I like winning in the investment game. I feel like I'm a capitalist. If you want to be a capitalist, just go through my episodes. This is what I'm talking about. This is what I do for a living now. I help people. I turn people from wage earners to capitalists. And it's a great thing. When people, that penny drops, they love it. And watch my episodes. Or if you want to talk to me, just look at the show notes down below. Find me on Facebook. You can share there. I'm on Instagram. I've got a YouTube channel. You can like and share there. Just get in touch with me or book a strategy call. I'm very happy to speak with you and see if I can help you. Talk to you soon. See you in the next episode. Hey, thanks for tuning in to The Passive Property Investor. If you enjoyed this episode, the best way to show your support is give a 5-star review on Apple Podcasts and Spotify. Make sure you subscribe to the YouTube so you don't miss a single episode. We're on all social media platforms, so feel free to connect with me there. And if you're having specific problems making your first investment or building your portfolio, maybe you don't know which location to invest in, how much you should invest, you're worried about who to trust, reach out for me down below. I will have the answers for you. Don't hesitate. See you on the next episode.